Okay, so you want to own a used car dealership. At first, the business looks almost too obvious. Buy cars for less than they're worth, park them on a lot, clean them up, finance the customer, and sell each one for a profit. Every vehicle has a price tag. Every buyer needs transportation. Every month, new people crash cars, move cities, start families, lose leases, get new jobs, and walk into the market needing something with four wheels. The strange part is that a used car dealership can look like a simple trading business from the street and behave like a leveraged finance company once you own it. The cars are the visible product. Underneath them sits a much more fragile machine, made of inventory financing, auction prices, repair risk, credit scores, online leads, compliance paperwork, lender approvals, and customer trust. The business is not just buying and selling cars. A used car dealer converts uncertain vehicles into trusted retail inventory. That sounds simple until one used car becomes 10 documents, 3 inspections, a title search, an emissions check, a loan application, a reconditioning bill, a warranty question, a customer complaint, and a clock that starts ticking the day the car lands on the lot. A new car dealer sells a product backed by a manufacturer. A used car dealer sells a product with a past. Someone drove it before. Someone maintained it well, or did not. A prior owner may have repaired it cheaply, ignored a warning light, skipped oil changes, smoked inside it, driven it through floodwater, or traded it in just before a costly problem became obvious. Your job is to discover enough of that history before the customer discovers it after the sale. That is why the first hidden asset in the business is not the parking lot. It is judgment. The second hidden asset is capital. Inventory has to be bought before it can be sold. If a dealership has 50 cars on the ground at an average inventory cost of $20,000, $1 million is sitting outside in depreciating metal before rent, payroll, advertising, insurance, software, licenses, and repairs are paid. A larger independent lot with 100 vehicles can easily have $2 million or more tied up in cars. A franchise dealer with a used department may carry far more. Most owners do not simply write a check for every car. They use a floor plan line, which is a revolving inventory loan secured by the vehicles on the lot. The lender advances money when the dealer buys a car. When the car sells, the dealer repays that advance and keeps the spread after costs. On paper, it is elegant. In practice, the dealer is borrowing against inventory whose value changes every week. A sedan bought too expensively at auction is not just a bad purchase. It is interest expense. It is lot space. It is insurance exposure. It is advertising spend. It is a price cut waiting to happen. If it sits for 90 days, the problem is no longer only whether the car can be sold. The problem is whether the dealer can recover enough cash before the lender, the market, and the customer all move on. Before that risk even appears, permission has to be earned. A dealership is not a lemonade stand with license plates. States control who can sell vehicles as a dealer, and the rules vary by location. California, for example, requires dealer applicants to go through steps such as fingerprints, an established place of business, and for used and wholesale-only dealers, dealer education and a written exam. Texas requires most motor vehicle dealers to hold a surety bond, and the common independent dealer bond amount is $50,000. Florida law requires a $25,000 surety bond or irrevocable letter of credit for motor vehicle dealer applicants. Those numbers are not the true entry cost. They are just part of the gate. The real opening bill includes the lot or showroom signs, security, dealer management software, insurance, business licenses, legal setup, vehicles, reconditioning capacity, working capital, and enough cash to survive mistakes. A small dealer may begin with a modest lot and a handful of vehicles. A serious independent operator needs enough inventory variety to attract buyers, enough cash to fix vehicles quickly, and enough liquidity to handle slow months without selling the wrong cars at panic prices. The physical location matters, but not in the way many first-time owners imagine. A beautiful lot with bad inventory will still fail. A cheap lot with no visibility can make every sale more expensive. In the old model, the road brought traffic. In the newer model, the internet brings traffic first, and the lot proves that the business is real. Customers compare listings before they visit, so a car that is overpriced by a few $100s may never get a test drive. The dealership is no longer competing only with nearby lots. It is competing with every listing a buyer can see on a phone. That changes the power balance. The customer knows more than the customer used to know. Pricing guides, vehicle history reports, market comparison tools, and online reviews compress the easy spread. A dealer can still earn money, but the money has to come from sourcing, speed, recon, discipline, financing, warranties, and process. The lazy version of the business, where the owner simply marks up cars and waits, is much weaker than it looks. The revenue stack begins with the front-end gross profit. This is the difference between what the dealer has invested in the car and what the customer pays for it. Invested cost includes the purchase price, transportation, auction fees, inspection, repairs, detailing, tires, brakes, batteries, and sometimes the cost of fixing a mistake that should have been caught earlier. A car bought for $18,000 may appear to sell for $21,000, creating a $3,000 spread. After fees and reconditioning, the true front-end gross might be closer to $1,700. A second layer comes from financing and insurance products, often called F&I. Many customers do not buy the car in cash. The dealer helps arrange a loan through banks, credit unions, finance companies, or a captive lender if the dealer is tied to a larger platform. The customer gets transportation today. The lender gets a loan. The dealership may receive compensation for originating the financing, and it may also sell products such as service contracts, gap coverage, tire protection, or maintenance plans. This can be a major profit center, but it is also heavily scrutinized because the customer may not understand the price, value, or alternatives. A third layer is the trade-in. When a buyer brings an old vehicle, the dealer has two opportunities at once. The trade-in can help close the sale because it reduces the customer's net out-of-pocket cost. It can also become new inventory if the vehicle is retail ready, or wholesale profit if it is sent to auction. The magic is not that every trade is profitable. The magic is optionality. A dealer that appraises accurately can keep the right cars and dispose of the wrong ones before they absorb too much time and repair money. A fourth layer is wholesale. Not every car belongs on the retail lot. Some vehicles are too old, too rough, too risky, or too far outside the dealer's brand. These units may be sold to other dealers or through auctions. The margin is usually lower than retail, but speed matters. A car that turns quickly at a modest wholesale profit may be better than a car that sits for months while the owner protects a fictional retail price. Service and reconditioning form another layer, especially for larger dealerships. NADA Data 2025 showed that service and parts sales at franchised new vehicle dealerships exceeded $164 billion in 2025, with an average of about $9.7 million per dealership. A pure independent used car lot may not look like a service business, but every vehicle still needs mechanical inspection, cleaning, and repair. If the dealer controls that process well, reconditioning becomes a margin advantage. If not, it becomes a leak that nobody sees until the month closes. The visible revenue is the selling price. The real profit is the difference between many small decisions made before that price appears. CarMax shows how powerful that system can become at scale. In its fiscal year ended February 28, 2026, CarMax reported about $25.9 billion in net sales and operating revenues. It sold more than 780,000 used retail vehicles and more than 538,000 wholesale vehicles. The company reported total gross profit of about $2.8 billion, including roughly $1.76 billion of used vehicle gross profit and about $524 million of wholesale gross profit. Its used gross profit per unit was $2,253, while wholesale gross profit per unit was $974. That is the machine operating with data-scale auctions customer offers finance capability and national brand trust. CarMax does not have to guess in the same way a small dealer guesses. Its annual filing says the company uses proprietary pricing algorithms, adjusts offers quickly, and monitors sale probability, age, mileage, macroeconomic factors, and pricing elasticity. In plain language, CarMax tries to turn uncertainty into a repeatable process. The company cannot eliminate used car risk, but it can spread that risk across enormous volume. Carvana offers a different success case. It built a digital used car model around online selection, home delivery, financing, inspection centers, and a national logistics network. The company went through severe stress earlier in the decade, but by 2025 it reported more than $20 billion of revenue, almost $1.9 billion of net income, and adjusted EBITDA above $2.2 billion. EBITDA means earnings before interest, taxes, depreciation, and amortization, a rough measure often used to discuss operating performance before certain financing and accounting charges. Carvana also reported nearly 600,000 retail units sold in 2025 and more than $7,000 of total gross profit per retail unit. Scale did not make the business easy. It changed where the difficulty lived. Instead of one local owner trying to price 50 cars, the digital operator has to manage inspection centers, logistics, customer acquisition, capital markets, securitization software, title processing, and national reputation. A used car remains a used car. The difference is that the factory around the car becomes more sophisticated. The cost machine is less glamorous than the revenue stack. Payroll arrives first. Salespeople, finance managers, title clerks, buyers, mechanics, detailers, lot attendants, managers, and accounting staff have to be paid, whether the month is strong or weak. Advertising comes next, because the cheapest car is expensive if nobody sees it. Online listing sites, paid search, lead providers, photography website tools, call tracking and reputation management can turn into a monthly tax on visibility. Then come occupancy insurance, utilities bond premiums, dealer plates, compliance systems, software subscriptions, auction access, transportation, and reconditioning. A dealer also carries inventory risk. Windshield chips, dead batteries, stolen catalytic converters, hail, vandalism, recalls, title delays, and customer returns all attack the same margin. None of these costs looks fatal in isolation. Together, they explain why a car with a $2,000 apparent spread can leave only a thin operating profit. The central trap is inventory time. A used car dealership can make money only if inventory turns faster than value decays and financing costs accumulate. The car has to be bought right, repaired right, priced right, advertised right, financed right, and sold before the market changes. When that happens, the business feels beautiful. Cash comes back, the lender gets repaid, the lot fills again, customers leave with cars, the owner sees margin become liquidity. A slow turn changes the same machine into a trap. The vehicle ages on the listing page. Customers wonder why it has not sold. The floor plan lender continues charging interest. The market may soften. A newer competitor listing appears. The dealer cuts the price, once, then twice. A repair issue emerges during a test drive. At some point, the owner is not choosing between a good profit and a bad profit. The owner is choosing between accepting a loss now or risking a larger loss later. This is why the used car business is so sensitive to wholesale prices. A dealer does not merely buy inventory, the dealer buys today's estimate of what a retail customer will pay tomorrow. If auction prices rise too quickly, the spread compresses because dealers overpay to keep the lot full. If auction prices fall after the dealer buys, the vehicles already on the ground lose value before they are sold. The lot may still look full from the road, but the equity inside that inventory is shrinking. Higher interest rates tighten the trap. NADA data 2025 reported that the average interest rate on used vehicle financing in the fourth quarter of 2025 was 11.3%, compared with 6.4% for new vehicles. The average amount financed on a used vehicle was about $27,500, with average used loan terms near 68 months. For customers, that means monthly payments can become painful, even when the sticker price looks reasonable. For dealers, fewer affordable payments mean fewer approvals, tougher negotiations, and more deals that die in the finance office. The lender has bargaining power because the lender controls the customer's ability to close. A buyer may love the car, have enough income, and still fail to qualify at the payment they expected. The finance company may demand a larger down payment, reject the vehicle because of age or mileage cap, the loan-to-value ratio, or reduce the dealer's compensation. A dealership can advertise freedom and mobility, but many transactions are ultimately decided by credit policy inside a bank or finance company. The customer never sees. Regulation adds another layer. The Federal Trade Commission's used car rule requires most dealers to display a buyer's guide on used vehicles and provide the guide to the buyer at sale. Dealers that arrange financing are also affected by privacy and data security obligations under rules such as the FTC Safeguards Rule, because credit applications contain sensitive customer information. Compliance is not the largest cost on a good day, but a weak control system can turn a paperwork mistake into fines, lawsuits, damaged reputation, or a lender relationship problem. The failure case becomes clearer with Vroom. The company represented the most ambitious version of the online used car fantasy: remove the friction of local lots, buy and sell at national scale, finance customers, and let technology make the market more efficient. During the pandemic-era boom, that vision attracted enormous enthusiasm because used car prices were rising, consumers were buying online, and capital markets were willing to fund growth. The original assumption looked reasonable. If customers were willing to buy cars online, a national platform could theoretically source broadly, sell broadly, and use logistics to overcome local inventory limitations. Every vehicle could be photographed, listed, financed, delivered, and monetized through the same digital funnel. The local dealership would become a website. Reality arrived through the balance sheet. Used cars are not digital files. They have to be acquired, inspected, transported, titled, repaired, photographed, financed, delivered, and sometimes taken back. When volumes are high and markets are rising, operational weakness can be hidden by revenue growth. Once financing tightens, demand normalizes, and inventory values become less forgiving, the errors become visible. In January 2024, Vroom announced that it would discontinue its e-commerce operations and wind down its used vehicle dealership business. The company said the decision was designed to preserve liquidity and maximize stakeholder value. Its 2023 results showed the problem. Full-year revenue was about $893 million, but the company reported a net loss of about $365 million. E-commerce revenue was about $576 million, wholesale revenue about $104 million, and retail financing revenue about $157 million. The total business still lost heavily. One line captures the danger especially well. Vroom disclosed that its 2023 adjusted EBITDA included a $27 million wholesale gross loss tied to aged inventory liquidation and write-downs as part of the wind-down. In plain English, the company had cars that needed to be sold, but selling them meant admitting the inventory was worth less than expected. The same product that was supposed to generate gross profit became a cash drain. By November 2024, Vroom had entered a voluntary prepackaged Chapter 11 process, and in January 2025, it announced that it had emerged after completing a recapitalization. The lesson is not that online used car sales cannot work. Carvana proves that a scaled digital model can recover and become highly profitable under the right conditions. The lesson is, sharper technology does not repeal inventory math. When a used car platform gets sourcing, pricing, operations, capital, or customer acquisition wrong, scale accelerates the mistake. A local dealer can fail the same way on a smaller screen. The owner buys aggressively because the last 3 months were strong. Auction prices feel high, but empty spaces on the lot feel worse. A lender offers enough floor plan capacity, so the owner fills the lot. Sales slow, the first discounts look temporary, repairs run higher than expected, online leads become more expensive, a few customers cannot get financed. Then the market drops another 2% and the accounting profit that existed in the owner's mind disappears before the cars leave the pavement. A one-year owner model shows how narrow the gap can be. Imagine an independent used car dealership with about 60 vehicles available and 35 retail sales per month. Over a full year, it sells roughly 420 cars at an average retail price of $24,000, creating just over $10 million of vehicle sales. That revenue number sounds large, but most of it immediately belongs to the cost of inventory. After vehicle purchases, auction fees, transport, reconditioning, and normal markdowns, assume the dealer produces about $1.2 million of total gross profit from front-end margin, finance and insurance income, some warranty commissions, and a modest amount of wholesale activity. From that gross profit the business has to pay the operating machine, payroll and commissions may consume about $500,000. Advertising, online listings, and lead generation could take $175,000. Rent, utilities, security, property costs, and maintenance might use $150,000. Insurance, software, licensing, compliance, accounting, and title administration may require another $125,000. Floor plan interest and fees could run around $150,000, depending on rates and inventory age. Add ordinary shrinkage, post-sale repairs, and problem vehicles, and another $75,000 can disappear. In that normal year, the dealership might clear roughly $225,000 before income taxes and major owner distributions. On $10 million of sales, that is not a money printer. It is a thin-margin operating company whose survival depends on fast inventory turns and disciplined buying. A few better appraisals, faster recon, and lower advertising costs can make the year look excellent. A few bad purchases can erase it. Now change one variable demand slows and wholesale values fall. Instead of selling 35 cars per month, the dealership sells 25. Vehicles sit longer, so the average markdown grows by $1,200 per unit. Floor plan interest rises because inventory ages. The store still has to pay rent, software, insurance, core staff, and listing fees. Total annual sales fall to about $7.2 million. Gross profit shrinks to roughly $700,000 because fewer cars sell and each unit produces less margin. Fixed and semi-fixed expenses still run near $850,000 even after some cuts. Add an inventory write-down of $150,000 on cars that were bought too high, and the year can swing from a $200,000 profit to a roughly $300,000 cash deficit. Nothing dramatic had to happen. No scandal, no fraud, no giant lawsuit, just slower turns, lower market values, and the same cost base. This explains why the best operators are often conservative in a way that looks boring from the outside. They walk away from cars that do not fit their model. They price inventory to move rather than to flatter the owner's ego. Reconditioning has rules. A buyer cannot keep chasing auction volume just because the lot has empty spaces. Finance managers are trained, but compliance has boundaries. Aging reports are treated like warning lights. A car that sits too long is not a trophy. It is a balance sheet problem. The used car business also punishes weak reputation more severely than many retailers. A restaurant can disappoint a customer on a $20 meal. A dealership disappoints someone on a $20,000 life purchase. Bad reviews do not merely hurt feelings. They raise customer acquisition cost, reduce closing rates, scare lenders, and make every future buyer more suspicious. Trust is, therefore, not a soft value. It is economic infrastructure. Inventory sourcing is the other battleground. NADA's 2025 data showed that new vehicle dealerships sourced a large share of used retail vehicles through trade-ins, with other vehicles coming from auctions, direct purchases, and other channels. For an independent dealer, access to desirable inventory can determine the whole business. Auctions are competitive and transparent, which makes bargains harder. Street purchases can be profitable, but they require appraisal skill and customer trust. Trade-ins are valuable because the dealer may understand the buyer's motivation and capture both sides of the transaction. Supply pressure after the pandemic made this even more important. Cox Automotive has pointed to constrained retail and wholesale used supply, tied partly to lower prior new vehicle production and fewer lease returns, even while lease maturities were expected to rise over time. Reuters has also reported that reduced leasing earlier in the decade crimped the supply of 3-year-old used cars and helped keep late-model used prices elevated. When the supply of clean, recent vehicles is tight, dealers compete harder for the same units. Customers face higher prices, and margins become harder to protect. The future of the business will likely be shaped by data, electric vehicles, and credit conditions. Data matters because pricing mistakes are too expensive to survive casually. A dealer that can predict retail demand, reconditioning cost, lender approval probability, and days to sale has a real advantage. Electric vehicles add a different problem. Battery health, charging access, software updates, warranty status, and rapidly changing incentives can make an EV harder to appraise than a conventional used car. The U.S. used clean vehicle credit applied to qualifying purchases made by September 30, 2025. But the IRS has stated that new, previously owned, and commercial clean vehicle credits are unavailable for vehicles acquired after that date. A dealer who built part of an EV sales pitch around tax credit economics had to adjust when the incentive window changed. Credit conditions may matter even more. Used vehicles are already expensive relative to many household budgets, and long loan terms can hide the true burden until the monthly payment is calculated. If rates stay high, lenders tighten, or delinquencies rise, dealerships feel the pain before the public sees it in a headline. The customer still wants the car. The listing may still look attractive. The deal fails because the payment does not work. None of this means a used car dealership is automatically a good or bad business. Location, inventory, discipline, financing relationships, regulation, interest rates, supply conditions, and management quality can change the outcome completely. The point is to understand the machine rather than treat the lot as a guaranteed path to profit. These figures are rounded and educational, not financial, legal, accounting, or investment advice. From the street, the dealership looks like rows of cars waiting for buyers. Inside the economics, it is a race against time. The owner is buying uncertainty, borrowing against it, repairing it, advertising it, financing it, and trying to sell it before the market reprices it. The strongest operators survive because they turn inventory into cash quickly and know which cars not to buy. The weakest ones confuse revenue with profit, inventory with wealth, and debt capacity with safety. So yes, you can buy cars, park them on a lot, and sell them for more than you paid. That was the easy version. The real version is harder. You thought you were buying a used car dealership, but what you were really buying was a leveraged trust machine where every vehicle has a history, every day has a cost, and every slow sale quietly tests whether you bought the inventory right in the first place.